Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Intel is making a major move with a $20 billion stock offering and an increased capital expenditure forecast for 2026, signaling a strong commitment to advancing its position in AI technology and semiconductor manufacturing. This investment aims to help Intel close the gap with industry leaders like NVIDIA and TSMC, which have been setting the pace in these critical areas. The photos highlight key elements of this landscape. One shows a close-up of a semiconductor chip, which is at the heart of the technology race, and the other depicts a large, state-of-the-art manufacturing facility, similar to those operated by top players like TSMC. Together, these illustrate the scale and complexity of the challenge Intel is taking on and the significant resources involved in competing at this level. This sets the stage for understanding how Intel's strategic financial decisions today are expected to shape its competitiveness and innovation footprint in the years ahead. Intel is facing a critical moment as it tries to catch up in one of the most important technology races in recent memory. In August 2026, the company made a bold move by launching a $15 billion public stock offering, one of the largest equity raises in its history, while also increasing its capital expenditure expectations for the year to over $20 billion. This decision reflects the growing demand for AI infrastructure worldwide, but Intel is also under pressure from competitors like NVIDIA, known for AI accelerators, and TSMC, a leader in advanced manufacturing. While this strategy shows confidence and urgency to regain market leadership, it also involves significant risks, including potential dilution of shareholder value and uncertain returns on the investment. The path forward requires balancing aggressive investment with careful execution amid a rapidly evolving industry. Raising $15 billion is essential for expanding manufacturing capacity to meet the rapidly growing demand for AI. This means financing new factory construction, tooling, and advanced packaging technologies. At the same time, it will help strengthen our competitive position by closing the gap with NVIDIA in AI accelerators and TSMC in contract manufacturing. We are focusing on raising equity rather than debt to maintain financial flexibility, protect our balance sheet, and preserve our investment-grade credit rating. Ultimately, this investment positions Intel to capture long-term growth in AI by developing physical AI hardware, advanced packaging, and custom silicon that will support innovation for years to come. Intel is increasing its capital spending for 2026 from around $17 to $18 billion to over $20 billion, with expectations for even more investment in 2027. This kind of spending is essential because semiconductor manufacturing requires huge upfront costs, much more than software, since building fabrication plants demands billions before seeing any revenue. Intel is not just focusing on chips for PCs and servers anymore. They are creating a broad AI ecosystem that includes processors, advanced packaging, foundry services, and specialized silicon. Their aim is to engage at multiple layers within the AI value chain, ensuring they play a significant role across the entire infrastructure needed to support AI advancements. The images here show the scale of the manufacturing facilities and infrastructure investments they're making to support this strategy. Intel's foundry expansion is a critical part of its strategy to become a major contract manufacturer, competing directly with industry leaders like TSMC. Traditionally, Intel manufactured chips mainly for itself, but now it's opening its doors to third-party clients, including competitors. This shift could significantly diversify Intel's revenue streams and position the company to meet demand beyond just its own products. At the same time, Intel is focused on disciplined capital allocation, ensuring that investments are closely tied to committed customer demand and clear return expectations, even while spending aggressively to build up manufacturing capacity and capabilities. This measured approach helps balance growth ambitions with financial responsibility. Looking at the image of the TSMC factory illustrates the scale and sophistication of facilities Intel aims to rival, highlighting the magnitude of the challenge and opportunity in expanding foundry services. The detailed microchip photo emphasizes the complexity and precision required in semiconductor manufacturing, underscoring why this expansion is so important for Intel's future competitiveness. Execution excellence is critical. Intel needs to meet the demanding requirements of its manufacturing roadmaps, launching new technology nodes on schedule and achieving high production yields to remain competitive. On the AI front, NVIDIA currently leads the accelerator market, so Intel can't just rely on heavy spending. It must capture significant market share by delivering strong products and solutions. Additionally, expanding foundry services to external customers will be essential. Winning large contracts will help improve the economics of new manufacturing capacity, making Intel a strong player, not only in its own chip production, but as a contract manufacturer competing with leaders like TSMC. All these factors together will determine how well Intel executes on this ambitious plan. Investors will closely watch the returns on this capital spending to make sure that the huge investments actually generate profits greater than their cost. Big investments like these can either build lasting advantages for the company or, if growth doesn't meet expectations, end up harming shareholder value. At the same time, managing financial strength is critical, since the high level of spending over time means Intel must carefully handle cash flow and maintain strong trust from investors to keep funding this aggressive strategy. Without that financial discipline and confidence, sustaining such heavy investment would be very difficult. The offering was initially planned at $15 billion, but was increased to $20 billion due to strong demand from investors. The company issued 210.5 million new shares at a price of $95 each, with an option for underwriters to purchase an additional 31.6 million shares if needed. This raised net proceeds of about $19.7 billion, which will help strengthen the balance sheet without adding any debt. The deal closed on August 12, 2026, and was led by major financial institutions, including JP Morgan, Goldman Sachs, Morgan Stanley, and Citigroup. This successful capital raise supports the aggressive investments outlined earlier, especially the expansion of manufacturing capacity and initiatives to compete more effectively in the AI semiconductor market. Issuing about 210 million new shares leads to a dilution of existing shareholders by around 4 to 5%. This move caused Intel's share price to drop as much as 4% on the announcement day, although it bounced back once the deal was finalized. On the business front, the data center and AI segment saw a significant increase in revenue, rising roughly 59% year over year in the second quarter of 2026, reaching approximately $6.3 billion. Despite this growth, NVIDIA still commands a dominant position with an estimated 80 to 90% share of the AI accelerator market. Intel's recovery is noticeable and promising, but it remains early in the process. Intel's decision to raise $20 billion and increase its capital spending is one of the deepest strategic bets it has ever made. The company is clearly anticipating that AI-driven demand will create a need for much larger capacity and more advanced technology. While this presents a huge opportunity for growth, it also involves significant risks, especially as competitors like NVIDIA and TSMC continue to extend their technological lead. The key to Intel's success won't simply be how much it spends, but how well that investment translates into technological breakthroughs and profitable growth. The challenge will be turning this bold spending into real competitive advantages that pay off over time. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.